This is my financial disclaimer so I don't get sued.
Good morning, good evening, good whatever time it is you're listening to this. I hope you're having a good one. Let's take a look at what we're covering in today's video. This will be my only video I will be doing this week, as I do have my in-laws coming in from basically halfway across the United States, and it is my birthday on the 17th, so I do want to spend basically most of Wednesday through Friday with them and just to be able to relax. So I will be doing the stream tomorrow morning on Monday, and I will be doing it Wednesday morning, but I will not be doing the stream on Friday this week, and I will not be putting out any of the usual daily technical analysis videos. So tonight's video will be covering the entirety of the week. So quite a bit to go over. So with that said, I will be covering the data sets, the earnings, and doing a technical analysis over the SPY and anything else we need to get into for the week of March 16th, 2026. And with that said, let's go ahead and get started with the data. Now, for the data sets this week, there truly isn't a whole lot. We have primarily the FOMC on Wednesday, which is at 2 p.m. But other than that, um, honestly, there's really no data that's going to shift the market sentiment other than if we get something, um, an extremely hot or extremely cool print out of the ADP weekly employment change. If we see something with the pending home sales that's just completely unorthodox. If we see, I'm not really worried about the February PPI, whether it's elevated or not. I don't think it'll matter that much. And for Thursday, the jobless claims, they've still been holding very steady, even though they're still fairly elevated, but they've been holding steady. So I'm not really expecting anything absurd out of that either. So really, it's the FOMC at 2 p.m. on Wednesday. Now, again, this FOMC is pretty much entirely priced in. If we check the CME, it's currently at basically 99% for a pause for this FOMC meeting. So that's basically what we've been talking about for the last few months now. Now that the real narrative has been building, we've been seeing what data sets have been coming out. We've been hearing about the conflict going on with Iran, and there's really no reason for them to reduce the rates right now unless there's an actual serious concern that requires the rates to be adjusted, which so far we haven't been seeing anything too crazy out of the SOFR rates. We haven't been seeing anything too absurd other than there has been some private credit, some major private credits blowing up and BlackRock reducing the withdrawals on their private credit fund and whatnot. So there's a lot of that going on, and that can definitely make its way into the market, but currently it's not drastic enough to warrant an emergency cut at this point. Um, if they do have to actually do an emergency cut, I don't think that they would wait for the FOMC. They would just cut as necessary. So really, that's the week this week. There really isn't a whole lot. Now, this week still is very important, even though there isn't a whole lot going on with the data sets. It is OPEX, and it's not just OPEX, it's the major OPEX. So with it being the quarterly OPEX, we have the SPX dividend on Friday. We have all the major expirations hitting on Friday. So it's a major OPEX, and with the X dividend on SPY, that takes the price, the top price down at least $1.70. Depending on the dividend, it might be closer to $1.80, but I do believe this one will be closer to the $1.70 range. So we will go over that. However, I do want to jump into the earnings before we jump into the technical analysis. And the main reason why I want to do that is because there really isn't a whole lot going on this week. We have Micron on Wednesday. which that can shift the market a little bit, but it's really not the massive company to do that. I could be incorrect about that. They can end up getting some overnight $500 billion deal like Oracle did that one earnings. Um, don't put it past some of these AI companies currently. However, in the grand scope of all the earnings, there really isn't anything that's majorly sticking out that's going to affect the market, unless Micron has something um new to provide to the AI market right now. I don't think they're going to shift the market too much one way or another, even if they have a very good earnings. We have Alibaba in the morning on Thursday. Yeah, nothing really much with the earnings. So yeah, not much with the earnings this week, not much with the data sets, and the CME FedWatch has uh the rate pause pretty much entirely priced in at 99%. So and I did believe there was some news about a potential rate cut being entirely priced out for the rest of the year, which they're saying that because it's less than that 50%. Yeah, interesting enough, even in December, um, we're seeing the odds shift drastically. Interesting. Anyway, that's not important right now. Just know that currently we will be pretty much pausing with the CME. So let's jump into the technical analysis.
If you're enjoying this, please check out my Patreon. For just $1 a month, you can join our community chat and access our tools like the Unusual Whale Spot and our own personal GEX and DEX market positioning. My $12.99 premium tier gives access to my personal trades, 2 live classes a week, which are on Wednesdays and Sundays, and direct support from myself. The links to join are below, but you can also join through patreon.com/wooksy. Thank you for supporting me to help you build skills for a lifetime.
And jumping right into the technical analysis as always, making sure we are on the daily time frame and that we have our moving averages and Bollinger Bands turned on. So we did get our move that we expected last week. We saw the 5 mile rejected after pulling down and rejecting that 20 mile range. From that 5 mile rejection, we saw the lower Bollinger day one secured. And from that day one, we saw the day two secured, which gave us that lower low. With that lower low, it closed this cup right here, which I can almost guarantee you there's going to be a absolute mess of drawings right here. There is, oh gosh, I apologize. I'm going to make a little cup right here and I'm going to make it white so that hopefully it's very, very visible. But this little inverse cup right here was filled to the downside, and from that downside and from that lower low of the day two Bollinger or lower Bollinger, we should be expecting the consolidation back up to the 5 mile. Excuse me, I'm losing my voice. Now, with the market closing at 662.29 on Friday, so it was a very deep close. I believe the market high of that day was close to the 672 range. With us hitting that 662.29 in the close, that means that the 5 mile should be around that 667, 60-ish range. It could be a little lower, might be a little higher, but that's where I'm expecting it to be. And the primary reason why is the overnight market right now currently is already starting to push back upward. This is something we fully expect when we enter that day two lower low of the bottom Bollinger. We expect market to slowly start to consolidate back upward towards that 5 mile, generally between 1 to 3 sessions after hitting that day two lower low. So far that is starting to work, and it is starting to be around that 667 range, which that's really what was talking about last week. Is I expected it to be around either that 665 to 667, so starting to be in that range. With it being at that 667, let's just base it right at that 667.50. That means the upper bounds would be at that 669.50, potentially at the 670, depending on if it pushes up with the market price pushing up with it. And the lower bounds would be much closer at 670, or that, excuse me, the 665.50. With it being a lot closer to that just standard 665 with the market pushing downward. Now, with that said, with this lower Bollinger move secured, this is confirming a couple things here. And I really don't want to bring up the drawings because it just looks like a mess, and I do apologize, but that's from the morning stream, so I will have to clean that up for, the next presentation. However, we have filled, and follow my cursor for a moment. I'm going to turn off the moving averages just so that this can be easily seen. We have filled this inverse cup right here, and from that inverse cup filling, we have completed the handle. And from this handle, we now, with this handle being completed, this nested inverse cup being completed, we now should be expecting an additional handle from it. Now, with that said, and turning the moving averages back on, retesting the 5 mile at that 667 range, basically right in there, would be perfectly in line with creating that handle to continue pushing downward if the market sentiment is wanting to do so. However, we have not tested the 20 MA since I believe it was March 9th, which was last Monday. So technically, we don't need to test the 20 MA for another roughly 3 weeks. However, with this downward action, that's kind of the price action I look for, and I will draw it out here, even though it will look like a mess. But basically, from the lower Bollinger, we expect pushing back upward either towards the 5 mile or the 20 mile. Here, I'm expecting the 20 mile as we did close some major inverse cups here. From that 20 mile, we expect a rejection back down towards that lower Bollinger. Rinse, repeat, back towards either the 5 mile or the 20 mile. Pull back down towards that lower Bollinger. And this is how the price action will work until we break this trend. Current trend right now is extremely bearish, and there's just no two ways about that. We have the 5 mile far, far, far beneath the 50 mile, the 10 mile pulling far below the 20 mile, the 20 mile pulling far below the 50 mile. And now the next real hurdle here is this 200 mile range. I know most people are expecting the market to just pull down and slam that level very, very quickly. However, I really don't think that any of the sentiment, at least from the news, at least from the earnings, this week is going to do that. I think that this type of week is really the type of week where we consolidate at this range for a while, allow the 5 mod to, or allow the 200 mod to continue pulling upward, allow the 20 mod to continue pulling downward, allow our other moving averages to continue pulling downward, so that we can really build support at this range to either have a major bounce or to continue down below that range. So that's truly the expectation, and especially with this week having OPEX, it is a major OPEX, and that means that the SPY X dividend will be hitting. That means roughly $1.70 off the top will be taken off. So, if the price was let's just say 601.70, it would open the next day at that 600. So, um there is some downside with that. And generally these major OPEX days are fairly red. However, I have seen some of these days where after that major selling action happens fairly early in the morning, we see a large majority of that weight bought upward. Now, usually that's due to some sort of data set, some sort of some sort of catalyst, right? I am not seeing anything currently that will do that unless something with the Iran conflict changes the market sentiment greatly. Um, with that said, all of our moving averages are positioned to the downside. If we do really start breaking this 5 mile level and start heading upward, then I still wouldn't be too worried. I'd be using that 20-mile range to set up new positions and fully expecting to continue down towards the lower Bollinger once again. So with that said, the real and full expectation would be expect that upward bounce, expect that consolidation. I wouldn't really fully expect the 20-mile range to hit at this level. However, it can. Um, but really know that the market is trying to push towards that 200 mile. Um, it has been, I want to say at least a year now since we've hit that level. Yeah, a little less than a year. Since we have tested the 200 mile, which that isn't completely unheard of. Sometimes we'll test this level once every 2 years. Um, but with it being the 200-day moving average, generally you're going to expect to see that within 200 trading sessions. With us being in a bear market, well, by my standards anyway, I know some people don't agree with that, but maybe they'll agree in another couple weeks if we continue our downward selling. But there's this major gap at the 648.93. I've been talking about this for about a month and a half now, ever since we've really started breaking some of these bullish structures, that this is coinciding very, very, very well with our 200-day moving average. Um, this would create an extremely large cup or inverse cup to the downside, and that is a massive amount of liquidity that the market has been building above for, over half a year now. So this is a lot of liquidity to basically take for free. To sell the call upside and now grab the put downside before they want to either continue upward or, chop the market and enter real bear territory. So that's the expectation. Now on the weekly time frame, the lower Bollinger on the weekly time frame is at that 660.57. So we are very close to that range. Not really at that range yet. If we start pushing down towards that 648 that I've been talking about, and really the 648, I've been expecting it to be a lot closer to that 646 because once we have the dividend hit, it will take roughly that 60 or 70 off the top, and it'll pull us a lot closer to that four or that 646. So that's the level I'm really expecting. If we get into the 20-mile range, that's the level that I'm personally going to be using to secure dated puts to the downside and fully just expecting to continue pushing to that range. Um, yeah, I think that's really about it right now. The ADL on the daily time frame is starting to look extremely poor. And again, the ADL is essentially like a bank account. So if we see it moving downward, that means that money is flowing out of the fund. We see it moving upward, then money is being put into the fund. Um, Money is starting to really flow out of here. So something to be, you know, very, very cautious of. Now, I just want to take a very quick look at semiconductors. We do have bearish structure here on the daily time frame as well. We do have, even though it's slanted, and I know some people will disagree with it, we're going to delete all these drawings. We don't need any of them. This is slanted, but this does have the liquidity for a head and shoulders still. So I would be expecting essentially semiconductors to pull up to the 20 mile range and start continuing down from there. Um, do have some very important liquidity around that 285. So that does coincide with SPY pulling downward, QQQ very likely some very similar structure going on, and we do. So we do have a very similar gap on QQQ at that 580 range. So a little less room to lose on tech compared to semiconductors, but really since the beginning of the year, semiconductors have been, overwhelmingly strong. Now, with that said, this is just a reminder that corporate credit, and this is the high yield, this is the HIG, has been starting to sell off, and this is a very, very, very strong indicator that equities are going to continue selling off. If you see major selling within the HIG, that's telling you point blank that there's going to be major equity selling. Same with liquid. We've been continuing to see major selling within liquid, and that coincides almost one to one with continued selling within equities. Now, with the conflict going on in Iran, we have pretty much seen the entire port of Hormuz closed. I haven't been tracking the actual tanker situation and whatnot, but currently I do know that oil prices are still going to be continuing upward until we see a major break from that conflict. So as long as these continue upward, these are still going to be weighing on US equities quite a bit, and that's still going to be driving up the dollar and the treasury yields, which also heavily weigh on US equities. So start being very cautious of this upside. It's not looking very strong with QQQ semiconductors, SPY all sharing some major bearish structures. It's starting to look very, very bad for the market. And I know some people will probably comment about it after, but I'm 100% expecting a small bounce here. But from that bounce, I do expect the continued downside. Um, if we have this bounce and start heading back up to the upside, I'd be extremely surprised because after we have the oil um, volatility calm down, we extremely, extremely likely will be seeing the Bank of Japan doing a major yen intervention. And that is because the yen has been pulling to dangerously, dangerously low levels. This is lower than when it was in 2025, and we're starting to get to the point where it's almost lower than where it was back when they had to intervene at in the middle or basically at the end of summer in 2024. So we're starting to enter very caution, or, very, very curious waters here in terms of how low the yen is continuing to sink. So yeah, that's my overall on the market this week. I'm expecting a small bounce to the upside, potentially all the way to the 21. And from that upward bounce, we should fully be expecting to continue downward unless there's some major sentiment out of again the conflict in Iran. So with that said, I hope everyone enjoys their week. I will be streaming Monday morning and on Wednesday morning. But again, I will be taking the rest of the week off. Other than that, um, thank you for joining the streams. They've been really enjoyable. And I've been very happy to see many people taking a lot of wins and just learning a lot of different experiences that I see when I trade. So those have been a lot of fun. I hope that many of you can, you know, join me on those. Other than that, I'll stop my rambling because it's hard for me to talk. I'm super tired. Have a great week, everyone. Enjoy your St. Patrick's Day. And yeah, just be cautious of OPEX. Um, we don't really have a whole lot of data or earnings to carry positive sentiment this week. The FOMC should pretty much be priced in. So, from a very, very small support upside bounce, um, again, I'd be really trying to position for that downside. So, okay. With that said, take care, have a great week, everybody, and I will talk to you in my next video, which very, very likely will be next Sunday. So, with that said, take care, and I will see you then.